Let's be real, making $5,000 a month just from investments sounds too good to be true, right? I get it, but here's the thing, it's not magic, it's math. And I'm here to break down the formula that can make this happen for you. In this video, I'll show you how to build a dividend portfolio that can pay you $5,000 a month. I'll show you the portfolio that can get you there, and you don't need thousands of dollars to start. In fact, I'm going to show you how you can start with less than a $10 daily contribution. And in the end, I'll show you the future projections of the portfolio and how it can turn this investment into over $1 million valuation that pays $5,000 in monthly dividend income. And don't worry, I'm keeping things simple. No need to be a finance expert to follow along here. Alright, before we jump into the stock picks, let's quickly break down what dividend investing is all about and why it's such a powerful way to build wealth. So what are dividends exactly? Think of them as a thank you from a company for owning its stock. Every time a company makes a profit, it might share a piece of that profit with its shareholders. That's a dividend, basically free money for holding onto the stock. But the real magic of dividends isn't just getting those regular payouts, it's about reinvesting them. When you use your dividends to buy more shares, you're boosting your future payouts. It's like a snowball rolling down a hill. It gets bigger and bigger over time. More on that later. Of course, there are a few risks too, like companies cutting their dividends during tough times. That's why we focus on picking solid, reliable stocks. Diversification is key here. You don't want to put all your eggs in one basket, right? Okay, so let's get into the numbers. How do you exactly reach that sweet spot of $5,000 per month from dividend investing? Here's the game plan. First, let's break down the math. To earn $5,000 each month, you're looking for $60,000 a year in dividends. But how much do you need to invest to get there? Well, that depends on the average yield of your portfolio, the percentage of your investment that pays out as dividends. Let's say you build a portfolio with a mix of stocks that gives you an average 4% dividend yield. To calculate how much you'd need to reach $60,000 annually, you divide that goal by the yield. So that's $60,000 divided by 4%, which comes out to $1.5 million invested. Now, I know that sounds like a lot of money, but don't worry, we're not talking about having $1.5 million on day one. It's about building up to that over time with regular contributions and reinvested dividends. And remember, even small amounts can add up. For example, if you start with $300 a month or roughly $10 a day and let your investments grow at an average rate of 7% per year, you could reach that $1.5 million goal by the time you retire. And that's without factoring in the added boost from dividend reinvestments. Here's where dividend growth makes a huge difference. If your portfolio's average dividend growth rate is around 5% per year, the payouts you're getting don't stay flat, they increase each year. That means your $6,000 annual target isn't just about the initial yield, it's about how that yield grows over time, helping you keep pace with inflation. And don't forget the power of compounding. When you reinvest those dividends, you're buying more shares, which means future dividends get bigger and bigger. It's like planting a money tree that keeps growing taller every year. Over time, this can snowball into serious cash flow even if you're starting small. And remember, the longer you let your portfolio grow, the closer you'll get to that goal without needing a massive lump sum up front. Next up, let's talk about the heart of this strategy, the specific stocks that make up our portfolio. Building a portfolio that can generate reliable monthly income means picking stocks that bring a balance of stability, growth, and consistent dividend payouts. Here's how I've chosen each stock and why it plays a crucial role in hitting that $5,000 per month goal. First up, I have the Fidelity Multi-Asset Index Fund with the ticker symbol FFNOX. This fund acts as a foundation for my portfolio, solid, reliable, and capable of holding everything together. It's a diversified index fund that spreads its investments across multiple asset classes, including domestic stocks, international stocks, bonds, and even a bit of real estate. The reason it's in my portfolio is simple: diversification. By owning a little bit of everything, FFNOX helps to smooth out the bumps during market downturns, giving us a more stable base to build on. Plus, it has a dividend yield of 2.88%. That might not seem sky high, but when you pair it with a dividend growth rate of 14.22% and an average share price appreciation of 10.85%, you've got a fund that's designed to grow steadily over time while providing a solid stream of income. Next, I've got the Pro Shares S&P 500 Dividend Aristocrats ETF with the ticker symbol NOBL, or Noble. Now, why would we want to include an ETF like Noble? Well, it's all about consistency. Noble focuses on companies that have increased their dividends every year for at least 25 years. I'm talking about the true blue-chip stocks, those that have weathered multiple market crashes. The dividend yield here is 1.96%, which again isn't that high, but the stability it provides is what really counts. Its dividend growth rate is 11.78%, which means that the payouts keep growing over time, helping to offset inflation. With an average share price appreciation of 9.04%, this ETF provides both income and also grows in value. Remember, in the end, I'm going to show you the future projections of the portfolio with these stocks and how it can turn a $10 daily investment into over $1 million portfolio that pays $5,000 in monthly dividend income. Next up in our portfolio is American Tower Corporation with the ticker AMT. This one isn't your typical stock. AMT is a real estate investment trust, or REIT, which means it owns and manages properties, specifically the cell towers that keep our phones connected. And why have I included a REIT like AMT? It's a way to tap into the growing demand for digital infrastructure thanks to the rise of 5G and data usage. AMT's dividend yield sits at 2.82%, which is competitive for a REIT, and it boasts a dividend growth rate of 17.48%. That's huge. It means AMT isn't just paying out dividends, it's increasing those payouts at a rapid pace. Plus, its share price appreciation of 9.34% means that as demand for digital infrastructure grows, so does the value of AMT. And because it's a REIT, it's also required by law to pay out 90% of its income as dividends, making it a steady source of cash flow. Up next, I have NetEase with the ticker symbol NTES, a name you might not be familiar with, but one that brings some international reach to our portfolio. NetEase is one of China's leading tech companies with a strong presence in online gaming, e-commerce, and digital services. Why include a stock like NTES? Well, it's all about diversification and growth. Having international exposure means that you're not putting all your eggs in the U.S. domestic basket. And NetEase's growth potential in a massive market like China makes it an attractive pick. NTES offers a dividend yield of 3.06%, which is quite generous compared to most tech stocks, and it's got a dividend growth rate of 19.44%. This means that the payouts are likely to increase significantly over time, giving you more income as the years go by. And with a stellar average share price appreciation of 16.61%, NetEase is a strong contender in this portfolio. Last but certainly not least, we've got the Home Depot with the ticker symbol HD, a stock that you can always count on. Home Depot is a giant in the home improvement retail space, and it's been a solid performer over the years. Its dividend yield is 2.17%, backed by a strong dividend growth rate of 17.25%. And Home Depot's average share price appreciation of 16.58% means that even during economic slowdowns, it has the resilience to bounce back and keep growing. HD's role in this portfolio is to provide steady income and growth, helping to balance out some of the higher risk picks like NTES. So why these specific stocks for our portfolio? It's all about creating balance that can weather the ups and downs of the market while steadily increasing your income over time. FFNOX and Noble bring stability and broad market exposure, making sure that the foundation of our portfolio is strong. AMT adds a touch of real estate and technology, giving you access to a growing sector that's becoming more and more essential in the digital age. NTES offers international growth potential, making sure you're not overly reliant on the U.S. market, while HD rounds things out with reliable consumer spending and strong dividend growth. So, are you ready to see how to put it all together? Let's talk about how you can structure your investments and track those crucial portfolio metrics. The key here is to strike the right balance between income, growth, and stability. For this portfolio, I'll allocate equal investment across all the stocks. If we average out the key metrics from these selections, we create a balanced portfolio with a 2.58% dividend yield, a 16.03% annual dividend growth rate, and 12.48% share price appreciation. This combination gives you a portfolio that provides regular income while also growing in value over time. Over time, this growth helps to fight inflation and make sure that your purchasing power actually increases. Now let's take a look at the future, because that's what makes dividend investing so exciting. It's not just about where your portfolio is today, but where it can be in 10, 20, or even 30 years. So let's say you're investing $1,500 per year, that's around $125 a month, or about $4 a day. Now, what can you expect over the next 30 years? After 1 year, you're just getting started with an initial investment of $1,500. Fast forward to 10 years later, your portfolio could grow to around $31,473. Give it 10 more years, and in 20 years, your portfolio's worth is around $182,047. Your dividends are growing too, thanks to that 16.03% dividend growth rate. And because you've been reinvesting those dividends, your wealth is compounding faster and faster. But here's where it gets really exciting. 30 years in, your portfolio has the potential to be worth over $1 million, $1,036,984 to be exact. And here's the best part. Your annual dividends at that mark would bring in around $61,443. That's about $5,120 per month, a steady stream of passive income. And how does this all add up? Out of that total growth, $668,233 comes from capital appreciation, your stocks growing in value. Another $323,750 comes from reinvesting your dividends, letting them multiply over time. Want to know how to turn a $120 weekly investment into a portfolio that pays over $15,000 in monthly income? Click the video on the screen.